What's making headlines? Your weekly wrap-up of the biggest news stories in the Australian mortgage and finance broker market.
Hello and welcome back to What's Making Headlines. It's Charlie, Ben and Annie with you today, unpacking the news of the week. And first up, I should say, everybody, happy new financial year.
I know. It's we've been writing about it for months and almost suddenly it's dawned on us. So
happy. I mean, I don't know if you actually say happy new financial year. Is that a greeting that we give to people?
We should
happy
make
new
it
financial
make
year,
it a
everyone.
thing. Yeah.
Happy new financial year to you, Ben. How do you feel about FY27?
I mean, and our side of the business, it's kind of business as usual as we sort of slip into a new financial year. But yeah, I guess for a lot of the people we're writing about and a lot of the clients they service too, it's a busy time.
Yeah, super busy time. We actually held a webcast this week on the last day of financial year to look at sort of commercial lending and what's been happening in that landscape, which was really great. And it was fantastic to talk to Connected Pepper and George Karam from BF Money for that webcast. But I did appreciate it was in the afternoon on the end of financial year, the last day of financial year. I was like, people might be in the pub.
Yeah, kind of is great timing to get that information, but yes, people
perfect timing to get that information to be like nail the new financial year with all of this insights and technology. But if you didn't manage to catch it live, don't worry, you can check it out on the webcast page of the Advisor website, and I would encourage you to do so because some really great insights in there, including all the stuff that's happening with SMSF, how brokers can be really delighting their SME clients, and of course looking at what else is on the horizon for commercial lending. We're looking at both what Pepper Money is doing, for example, what Connective are doing to support their brokers and what brokers are doing as well. But because it's a new financial year, there's a raft of new changes that come into being this financial year, FY27. We've been talking about them for a month, I think, since the budget's been announced, but even before that. One of the big ones we've been talking about, I think, both on the news and in the magazine, has been the Payday Super coming in. Now, both you, Charlie, and you, Ben, have been writing about this a lot. Ben, I think you wrote a couple of features and articles with SME lenders, particularly looking at Payday Super. What's sort of your thoughts about the new contribution rules?
Well, it's going to affect every business differently, I suppose. I mean, as our listeners will most probably be aware, it kind of changes the payment cycle of an employee's superannuation. So rather than sort of being able to pay this quarterly, they have to pay it within each pay cycle.
Within 7 days, yeah.
Within 7 days, sorry. Which doesn't change the amount that's owed to an employee as a super contribution, but it probably would impact those businesses that sort of potentially those businesses that have that sort of lumpy cash flow. There might be sort of seasonal businesses and that kind of thing. So that's something they're probably quite aware of at the moment, and that's maybe a cause of pressure moving into the new financial year. Yeah,
for sure. And Charlie, I think you were writing about this as well on the Advisor, or on the 1st of July, just to be like a reminder, because of course it's not just brokers don't need to be across it because of their clients needing to know, do they have enough cash flow? Are they aware of it? Do they need any support accessing finance to provide it? But also small businesses themselves, brokers, will need to be paying it too if they have employees. What are your kind of summary findings from the stories that you've been writing about Payday Super and what people think about it?
Well, it's been on the horizon for so long now, but despite that, there still seems to be an awareness and a preparation gap in a lot of the stories that I'm writing, and even the polls that and surveys that are being conducted in the last few days. Once it's in effect, there's still a pretty major awareness and preparatory gap as well.
Yeah,
I read a story a couple of weeks ago, and I included it in the update story on, well, here's what you need to know about Payday Super coming into effect, on a survey that SME lender Prosper ran. And funny enough, they ran a survey of small business owners in February and May. This was in tandem with YouGov. And the February poll found that 41% of SMEs didn't understand it. 30% hadn't heard of it at all, and 25, even all those months later in May, still 25% remained completely unaware, and 11% said they didn't really grasp the change. They didn't understand the change. But I think more concerningly than that, there was a rise in small business owners that aren't quote unquote prepared for the change from 19% in Feb to 23% in May.
Yeah, so
that's
more
not
of
a
them
good sign.
unprepared.
Yeah.
I guess because as it gets closer, if they aren't aware of it, they haven't done anything about it. As
Yeah.
you get closer and closer to it, you're like, oh my god, I've only got 2 or 3 weeks before my next pay run.
Yeah,
I need to actually find this money very
Exactly,
quickly
yeah.
if I haven't like accounted for it.
Yeah.
So yeah, there's going to be lots of brokers, I'm sure, in the SME space, and more generally those with self-employed clients, that have employees thinking, well, I might be quite busy the next few weeks.
Yeah.
As the first pay run comes through, people realize they have to find this.
Yeah. You get slugged a charge as well if you don't meet that 7-day.
Well, you don't want to be not meeting your obligations.
I think the
It's
ATO is
fair
going to
enough.
be quite lenient in the first.
Are they?
Well, they've said they are. They've said that there's a year-long educational transition period, but
Okay.
still they've also put small business owners on notice.
Yeah, because I mean, we know the ATO has been quite aggressive on chasing small business ATO debt recently, but of course that's been kind of a lag from a few years back. So they're kind of chasing this money. So, lots of money outstanding, I think billions outstanding from small
dollars
businesses. So lots of moves in there. But the other thing that happened this new financial year that will be relevant for brokers as well is the instant asset write-off again coming in. So they introduced the legislation to make it another year of 20,000,
Yep.
which brokers are kind of like, great. I mean, I'm glad that we have it. It would be nice if that was larger because, of course, think back to the heydays of COVID when it was 150,000. But still, $20,000 of assets you can write off in your tax return if you're a small business.
Yep.
If I think that's, if you've got turnover under $10 million,
10 mil,
yeah,
yeah.
so you can kind of buy lots of different assets and it's applies each time. So it's up to $20,000 per asset. So you can kind of use it multiple times. And this is, again, something that we've been talking about a lot because currently the legislative cap is $1,000. And so every year they're having to rewrite the instrument to extend it for another financial year. But we know now from this budget, finally they've agreed to actually make that permanent. So lifting the permanent cap to 20 grand.
Yep.
So while that is still going through Parliament, I think it was introduced this week into Parliament to make it permanent, we do know that is also taken into effect this financial year.
Yeah.
All sorts going on though. I mean, we've seen across the board, everyone's still focused on absorbing the ramifications of the SMSF LRBA ban for resi property that was announced. When was that? 2 weeks ago?
Last week.
Was it last week?
It was last week.
Can't have been
It was
last
last
week.
Tuesday.
That
So
feels like
we've
ages
crammed,
ago.
We've crammed. There's been a lot of developments in about a week and a half.
Wow.
Yeah,
That
from
feels
Tuesday
like
to
I
this
was like 2 or
Friday.
3 weeks ago.
Yeah.
Wow. Okay. Wow. Time
Yeah.
flies.
Yeah.
Or doesn't fly. I don't know.
Yeah, it's. I think just because we've been living and breathing it, in the moment, it's felt like longer.
Yeah.
Just because every day, or more or less every second day, we're writing about it, and someone's raising a new concern or a new detail is coming out about
So
it.
you've been talking to lots of lenders and brokers about it as well. Obviously, I think the initial shock has now worn off. People
Yep.
are like,
Coming to grips
okay,
with it.
we're coming to grips with it, but still not thrilled about it generally. And lots of the lenders now starting to figure out what they're going to be doing on it too.
A lot of bruised people out there.
Yeah, so lots of kind of, figuring out what it means, how we're going to be working towards it. So we know it's going to be taking effect from mid-August because it's usually about 7 to 10 days after a bill passes that it gets royal assent, and then it takes 45 days after that. So mid-August is the current kind of period we're looking at. But yeah, it's going to have lots of changes and everyone's thinking about that, of course. And the other big thing that everyone's talking about is mortgage fraud. Still lots ongoing here.
Yep.
There was reporting over the weekend that was pretty interesting from the Australian Financial Review looking into this. They had some, sources telling them about potential mortgage fraud being identified by the major lenders, NAB and CBA. Really delving more into this and saying that, they'd exited some people from the banks. They've been reporting accountants and brokers to the regulators and to police where necessary, where they've been identifying instances of fraud. Really fascinating coverage from the AFR. And of course, we reached out to some of our readers to be like, well, what does this all mean for you, Charlie? You were talking to the FAA about this.
Yeah.
Because every time we see these headlines and these stories about mortgage fraud, it nearly always focuses on the broker channel,
Yeah.
which is interesting to me, considering that we very rarely hear about what are the bankers involved doing? Like, we know that, NAB, for example, said they'd exited bankers. We know the banks have been letting go of the bankers, but
Yeah.
we never hear about them because most of the information is coming from the banks. So
Yeah.
they're very willing to talk about third-party fraud, probably less willing to talk about it first party. So
And the brokers that have been allegedly caught up in it, are themselves oftentimes ex-bankers that have become brokers, which I think is quite interesting as well, that gets lost in the broader debate.
Yeah. So again, some of the coverage that I think the FR was reporting was suggesting that maybe these bad habits are being formed in the banks. These bankers are being let go by the banks. They then become a broker, and because there isn't this kind of cross-industry reference checking, we do have reference checking within, with our own industry. There isn't always bankers necessarily willing to say there was something, they were let go for some reason, or there was suspicion of this.
Yes.
The problem then being that they become a broker and then they know all of the systems and the loopholes and how to get around the bank systems. And so then it kind of is a constant cycle. So pretty interesting. And this is, of course, leading to some people to say, well, we need better reference checks.
Yeah.
But what did the MFAA say? Because, of course, brokers, were getting a lot of negative pushback in the media. It always, I guess, makes some people start questioning, well, should I trust a broker? What have they got to say about it?
I think it's a good point as brokers kind of navigate this headwind of the fraud and how to convey that to clients who might be worried or anxious, who are reading these kind of headlines. But I reached out to the MFAA and the FBAA, and the MFAA first stressed that the discussions of brokers allegedly involved in mortgage fraud shouldn't tarnish the entire industry. And, the majority of the good apples out there that are actually dotting their I's and crossing their T's and aren't involved in this whatsoever. So she also stressed that it's also a heavily regulated industry.
Yeah.
Already.
More so than the banks, actually. A lot of bankers don't have the same requirements as brokers.
Exactly. And she kind of said, Naveen,
Alawala, yeah.
Yep. Policy executive at the MFAA stressed that it's a tightly regulated industry with many safeguards, and that brokers really need to be conveying that to their clients, that there are already safeguards and stopgaps in place, and that it's a highly scrutinized industry. It's safe.
Yeah.
And we are a trusted channel. And just to be forthright and upfront with their clients, and with that broker market share from March, she was referencing that, well, with the share rising to 81, a record high, it just shows that
81%.
How 81%, how much trust that borrowers have in brokers with these massive life decisions of seeking out a home loan.
And it's the same, I guess, like if the banks are also saying that accountants, they identified and flagged some accountants that were kind of supposedly accused or suspected of doing wrong. You don't really see that same backlash in the accounting channel. You don't see people going, I'm not going to trust accountants.
No.
But for some reason they do with brokers. So yeah, interesting times.
I spoke with the FBAA as well, and its new Chief Executive Officer, Leo Gakic. And he raised some valid points as well. And he basically said that brokers should be upfront and forthright with their clients and be transparent as possible, and use examples of existing client relationships, how they've helped existing clients with new clients, as to build and foster and continue to build and foster that trust.
That's probably the first time we've heard from the new FBAA CEO. Exciting. We have to learn how to pronounce his last name. Yeah, we're not sure. Is it Gagic? Is it Gagic?
We'll confirm that.
If anyone knows, please let us know.
Yeah, we'll confirm that. But it was interesting to hear these insights from the industry associations, because it is a real thing as well, because it's being increasingly spoken about. And I think consumers are starting to really buy into it and pay attention as well. Their heads are beginning to turn.
And I think this is also what forced NAB's hand over the weekend, following all of these reports from the AFR, to actually come out and release a statement, because they were pretty much first and foremost at the forefront of a lot of this reporting from the Financial Review. Ben, you were talking about this earlier. What did NAB say?
Well, NAB said a lot of the things you would expect them to say, like they've referred the multiple parties to the appropriate authorities and that sort of thing, and they take an uncompromising stance on this kind of behaviour. They also said they're working closely with their peers within the Fintel Alliance and law enforcement to sort of share intelligence and strengthen their response to this sort of thing. But they kind of was saying that more needs to be done and there needs to be more coordination. So they've called for the development of a national economic crime strategy to sort of get that coordinated approach and really change how banks, regulators, law enforcement and government work together to tackle these kind of issues. Because when you're sort of working against sort of these massive, elaborate crime syndicates and you're treating them as single problems, you're not really, requires a system-wide response, which is sort of what Nav was saying.
And I think this, again, a lot of what we've been talking about in the mortgage fraud seems to be from organized crime cartels and from kind of syndicated groups where there are multiple players all referring to one another and sort of, crossing into a broad array of the whole sort of financial services system. So bankers and brokers and accountants and conveyancers and lawyers, all kind of working together in concert to commit large scale, whether it's fraud or, or AML CTF breaches. Couldn't remember the word then. I was like, what's the anti-money laundering? Money laundering is the word I was looking for. There we go.
Yeah, and there's already a little bit of work being done in that space. We've reported on some of the work Austrac is doing with banks and law enforcement to sort of map the extent of loan scams throughout the sector. And there's also been a push. There's that open letter I think the industry sent to the Treasurer earlier this year calling on the CDR to be expanded to include ATO data and ASIC registry information. So there's a little bit of a push as well. And you can only expect as more and more of these cases come to life, pushes more and more of these.
And I think the MFAA is also working on this. I think Naveen from the MFAA, who you talked about earlier when you were writing that story, is also spearheading some sort of group on this in the third party channel.
Yeah, so Naveen is leading the introducer and referrer working group, which is bringing together major banks and aggregators to address fraud risks in this part of the system.
Yeah.
As part of this whole mortgage fraud scandal as well, there's been a lot of discussion about the impacts of these referrers and introducer systems. Initially, when CBA first reported itself, that was brought up a lot, and it was discussed, and the FBAA weighed in on that as well. And ex-CEO Peter White called for that introducer schemes that some of the banks operate to be abolished. There's like a lot of scrutiny around that element of it as well, of kind of referrals and
I know the broker channel has been really vocal on this as well, because of course, like, why should an introducer get paid for referring a name, whereas a broker gets paid for doing all of this work, hours and hours and hours of work? It doesn't seem fair to them that they have unlicensed non-financial services people referring in names and getting paid for it. The other thing, of course, is Equifax. We spoke to for a story on our sister site, Broker Daily, about this as well. And they've been doing a lot of work on the fraud space, and they're bringing together different players from across the financial services industry to look at who might be committing fraud. It's actually fascinating looking at how lenders identify fraud and what they do once they have and how that all works. If you haven't checked that story out, I'd recommend that too. But yes, generally, a lot of work going on. I think a national coordinated response does make sense, because, of course, this is very difficult to manage. I was reading this morning as well an article about how some fraudsters now are using documentation to hide prompts for AI within the documentation itself that you can't see visibly. It's within the actual metadata, and then that actually causes the AI to embed some sort of malware into the system. It was on our sister title, Cyber Daily. Fascinating read and terrifying at the same time. So being really freaky. You can't see this coding, it's in there, and then it actually makes the AI go and do something naughty.
Yep.
So
worrying.
Very a concerted effort needed across the board, not just in Australia, but I think globally.
It's a lot of moving parts too.
We'll take a quick break here and we'll come back and unpack some more changes that have happened because of the new financial year, plus what's going on with housing and house prices, and we'll get into that this after. So because it's FY27 now, we've had some new updates from some of the federal housing schemes as well, including Help to Buy, which is the federal government's shared equity home buying scheme, which launched in December last year and has kind of been slowly rolling out across the country. And this week they confirmed that there'll be higher income limits for those wanting to apply through the scheme, as well as more places. So every year now we get 10,000 new places under Help to Buy, and every year we also get income limits increase because they are wage index basically. So it's a slight uptick in the applicable salaries. So as of the 1st of July, if you are a single applicant wanting to purchase a house in tandem with the government, then you can do that if you earn less than $103,000. If you're a joint applicant or a single parent, you need to earn less than $165,000. So those are the new income limits. They were 100 and 160 respectively, so marginal increase. But it's interesting, I think, when they did release this information about the new limits, they were also unpacking who's been using the scheme so far and how many places have been taken up. And as I say, it's only actually been in being for about 6 months, only available through 2 lenders. But we'll get into that in a bit. But I think the people using it was pretty interesting. So they've had 7,200 applications, which is quite a lot considering they only have 10,000 spots a year and it's only been live for 6 months.
Yep.
And within those, 4,800 have either settled or they've found a home and are about to settle. So quite a good conversion rate so far, looking at that. And then 70% of those are single applicants, including 12% who are single parents.
Wow.
Interestingly, 86% were first home buyers. So I think you don't have to be a first home buyer to Help to Buy, but it is available for first home buyers. And I thought that was pretty interesting as well. Because seeing it is actually really supporting the people that it was kind of invented for, those first home buyers, to get onto the property ladder. And they did also point out, Housing Australia, the body that administers the scheme, that single women were particularly a growing cohort of the scheme. So it's 42% of female participants were aged over 40, which I thought was also quite interesting.
Yeah.
So, yeah, I love seeing those stats come through from Housing Australia. It's probably the first lot of stats we've had come through since Help to Buy launched. And it has, as I said, been growing over the last few months. So it started off with, I think, New South Wales, Victoria, ACT and South Australia in December, and then expanded out to Tasmania and WA earlier this year. And they all have slightly different property price caps, which unfortunately haven't changed. There we go. So that was income limits for Help to Buy. What do you guys think about it? Do you think most people are interested in Help to Buy? I think from our comments section, not many brokers are that keen on it.
It's interesting. It's interesting to get a little bit of data on the profile of the borrowers who are taking it up. So to see 70% of the people who have utilized the scheme so far as single as well. And sort of only have that one income to drop on is really interesting. And also the data about the median deposit size as well, which I think was just $30,000
$30,000,
as well. So I think it's still early days. It'd be interesting to see how it looks a couple of years down the track. But I guess encouraging signs in a way.
It's encouraging as well to see that those participants and users of the scheme are, as you were saying, Annie, the intended kind of recipients. But also it's good to see that the users of the scheme are those that otherwise couldn't or would be a lot more difficult for them to enter the housing market without these kind of stepping stones. And so it's encouraging and optimistic to see that there are people out there who are really assessing their options and seeing what is available to them and what any one of these state and federal schemes they can utilize to enter the market, because it is very difficult. So doing whatever you can, really.
It's a tough time. You actually wrote a story, didn't you, this week about housing affordability? And I think while you were writing it, you were like shaking your head, like, well, we're never going to be able to buy property, are we? Like, it's all super unaffordable. So having these schemes does provide some
it helps. It's a good leg up.
Some routes for borrowers. And just for anyone who hasn't heard of Help to Buy, where have you been? But this was where the government will contribute up to 40% of the purchase price for new homes and 30% for existing homes. So the larger one obviously being because they want new supply to be encouraged. But the big question with this scheme, as always, is not only, well, why are so few lenders on it? There's only 2 lenders, CBA and Bank Australia, currently on the lender panel. And only one of those, Bank Australia, is letting brokers write these loans. CBA is only doing it direct. Housing Australia keeps saying that more lenders will be added to the panel. They originally said May, they'd announce more. Then they said June, and now we're in July and we still haven't heard any more. So I wonder, is it a lack of appetite from the lenders that they don't want to be offering these loans? Don't know.
Well,
if you're a lender, let us know. Why aren't you applying for it?
I mean, people are clearly flocking to these schemes, and loan demand and inquiries is down, that's somewhat unrelated. But I don't see why the lenders wouldn't be taking every kind of opportunity for them to write more loans, especially if the government's giving them more or less a monopoly.
A guarantee, yeah.
And you're not doing it through a third-party channel, you're doing it directly, then that's a pretty good incentive.
Will they be left less profitable than their standard sort of first-time buyer?
That is the big question.
I think
Will they be
that's
making less money on it? And I guess the
undertone.
other big concern about this scheme as well is, well, do you really want to be purchasing property with the government and then potentially owing the government money if you go into negative equity?
Yeah.
So this has been a conversation that has really come to the forefront recently because we've been seeing house prices starting to fall. Now, this is although Anthony Albanese and Treasurer Jim Chalmers have never actually said they want house prices to drop in so many words.
Yeah.
They do want housing to be more affordable, as they keep saying.
Yeah.
So really kind of some of the consequences of the rate hikes and obviously I think generally subdued confidence, lower wage increases. Generally, we're seeing house prices starting to cool off. And this is something that's been pretty interesting this week, seeing Totality and PropTrack figures for was it the June quarter?
June.
The year to June. There we go. Seeing drops in house prices across the board, particularly here in Sydney and, in New South Wales and in Melbourne.
Yeah.
South Wales, Victoria,
Sydney leading the pack.
Yeah. Which, as we say, kind of has to cool off a little bit.
Yeah, it's more or less inevitable.
Been growing substantially. And over in WA, year-to-date growth in WA has been eye-watering. I think something up like 40% or something mad.
It's certainly up there in double figures.
Yeah.
Although that's starting to come down as well, which I think is starting to raise some eyebrows. It's pretty uniform across the board. Obviously, Sydney and Melbourne and the ACT and Canberra are crossing the 1% mark. Sydney was 1.2, 12 months to June. Melbourne was 1, so a little bit more subdued. But like you were saying, it's just a mix of factors, I think. And I think it's just because sentiment is so low and uncertainty and kind of ambiguity is so high, just as all of these raft of budget changes have come in. I think people are just preferring to stay on the sidelines a bit, certainly like buyers. But sellers are the ones here that are going to be having a difficult time.
Yeah.
I read a couple of articles of sellers starting to get creative and houses obviously being on the property market
For a long time.
for longer. But the government seems unfazed.
Yeah, because they've been really kind of asked this a lot the last few weeks. Is I think journos trying to get sound bites of them. They want a soundbite of them saying we want house prices to come down, and then really push them. So we constantly, every time we hear from any of the housing ministers, the Treasury, or the Prime Minister Anthony Albanese, nearly always there's a question coming out talking about it. So what did they say this week?
Well, I think Claire O'Neill has found a good substitute, and she's been saying it for weeks since they announced the budget changes that there needs to be a correction in the property market, and her kind of using that as a pseudonym for, well, we don't mind too much that property prices are dipping month on month because Treasury estimates show that they'll be still rising on the combined capital year on year by 2 and a bit %. So we don't really read into short. The Prime Minister Anthony Albanese and Claire O'Neill were brushing off these June figures and saying, well, we're more forward-looking.
And they were saying, this is more about rate hikes.
Yeah. And it's they didn't really accept that majority of the onus and emphasis was on the budget changes. They've said it's a mix of factors, the 3 consecutive rate hikes.
Yeah.
And you've got the war in the Middle East as well, which is still percolating, and that's had a major drag on sentiment. But
just going back to that figure, sorry, you said earlier, I think you said 2% growth rate. It's not a 2% growth rate. It's a 2% slower growth rate than originally forecast.
Yeah.
So I think it's more like 5%.
Yeah, I think it was originally forecast. Sorry, I should rephrase. It was originally forecast to grow by 8.6, and they've revised that by about 2.5%. So it's down.
Yeah.
But it's still going to grow. So
it's
no,
6%.
it's not going to
Still
grow
growing.
2%.
Yeah,
It'll
I was
be-
like, that's really low.
It'll be higher than that. I think
About 6%.
the forecast, there was a domain forecast done for FY27, which showed that it would be a lot lower. And certainly in the major eastern capitals like Sydney and Melbourne, it could be the downturn could be year on year as high as 7 and 8%.
Depending on which years we're talking about here. We're confusing ourselves a little bit because I think we were talking about calendar year, now we're talking about financial.
Yeah, that's financial.
Yeah.
So the projections and the forecasts really vary, but I think the government ministers are kind of stating that it's encouraging to see that there isn't as much competition in the market, and pointing to falling clearing rates as, you know, not a negative. Yeah.
Yes, just tell that to the vendors.
Yeah, exactly.
Poor things. But I think for everyone else, you know, like if you've got a mortgage, of course, the main concerns that a lot of first home buyers have is saying, well, I might have just bought a property, now I'm in negative equity, but over time you'd hope they would come back out of that. You know, if they do drop into negative equity, you're hoping you're not paying a mortgage that's higher than the worth of your value for too long, because as we know, property prices generally do continue to go up.
Yep.
So fingers crossed, if there is anyone in negative equity, they're out of it fairly soon again.
Yeah. And all the banks are forecasting it to recover.
Yeah.
Come next calendar year. So
yeah, just a period of tightness while interest rates are still a bit high.
Yeah, for sure.
Speaking of which, interest rates, we don't have another decision until August, but we did also get some minutes out this week from the RBA from their June decision, not really tailoring as anything new that we already knew.
Not so much.
Didn't know, but yeah, they were kind of saying, basically they're a little bit hawkish and being like, well, we'll see.
Yeah, the minutes weren't as, I guess, explicitly optimistic as a month prior in May, when they were using outright terms like these hikes provide us with space.
Yeah.
It wasn't to that extent or level, and the banks drew attention to that of stating and outlining and pointing out that, well, the Reserve Bank is still pretty worried
About inflation.
that inflation is too high for their liking.
Yeah.
And the minutes really pointed to that. But at the same time, as the monetary statement did, it also pointed to the fact that financial conditions have tightened and activity is lower.
Yep.
The economy is slowing. So they're really just keeping the ball in both courts at the moment. I think trying to be as generic in their language and not to rule in or rule out anything, because they may need to hike again. And so I think they're just trying to keep that option open.
Yeah.
And not shooting themselves in the foot by saying something and then giving the market an inch and it taking it a mile and going, oh, well.
Well, a lot of the central bankers this week have actually been over in Sintra in Portugal, which is a stunning place. If anyone's not ever been, I would totally recommend it. It's gorgeous, like lots of medieval castles, not far from Lisbon. They've been all there, all central bankers, pretty much from a lot of the developed worlds, talking about not just inflation, but a lot about AI as well, and what that's going to look like for the sort of stability of the financial system. It's been fascinating seeing that. We haven't really covered too much about that though, because they haven't really said anything about mortgages. But we generally are seeing a lot of activity, I think, across the world in people looking at what's happening in the macroeconomic landscape, you know, globally, and what's happening with AIs. Lots of chatter. I think we had from APRA this week about the threats of AI and what they expect banks to do, and kind of saying you really need to shore up your defenses.
Yeah. Been
A
talking
lot
about
going on.
Yeah, a lot from the central bank this week as well, putting out a new kind of framework. They did that on Monday of the additional levers that they could be pulling.
Oh yeah, if there was a super low interest rates. Yeah.
If rates were back down to zero, and reflecting on the last time that happened and some mistakes that were made. So, and a lot from the regulator. We're hearing increasingly from the regulators as well, ASIC and APRA, on a variety of things.
Everybody's busy.
Yeah.
When we come back, speaking of the regulators, we'll be looking at what the compensation scheme and last resort have been talking about, because they've released some new estimates for the levies for FY27, and we'll get into that just after this break. So who doesn't love to pay a levy? Well, it seems like we have so many in this industry to keep track of, whether it's ASIC or CSLR or AFCA. There are so many. But we did have revised estimates come out from the compensation scheme in last resort on Thursday.
Yep.
And this is an interesting one because they have been looking at how they actually fund the scheme. Obviously, lots of blowing out of costs in the last few years following the collapse of many different companies in the personal advice space, which has been blowing out the levies that are in that sector.
Yeah.
But also an increase for credit intermediation, which is what covers the industry, obviously our industry, broking industry.
Well, yeah, across the board. Although if we divide it down by subsector, credit intermediaries decreased.
Oh, well, that's good then.
Which is good. So it's not all doom and gloom. For our sector, it decreased. Only marginally. The CSLR revised estimate for the FY27 levy put the subsector at 2.1. A slight reduction from 2.2 million. So it's down $100,000.
Yeah.
That revised
Hooray.
estimate. But the total compensation scheme of last resort levy has skyrocketed.
Because of personal advice.
It's basically all to do with financial advice, and it's up by $60.7 million to a combined sum of $198.1 million. And the initial cost was 137. So it's very much shot up, and that the financial advice subsector has also blown out.
We're not going to focus too much on this because there is so much uncertainty.
But the special levy
still.
has been called in. I think it's worth noting that special levy is now in effect once again. So brokers will have to be paying a portion of that special levy.
Does it say how much it is?
No,
Oh,
it didn't detail
shame.
it. That's
because
to come.
yes, and I think this is what I was going to say about the personal advice section. We're not going to focus too much on it because there is so much uncertainty. Even reading the estimates from the CSLR, they're like, we're going through this reform process of how we actually charge levies. There is a special levy consideration to go through if the minister decides to apply one.
Yeah.
We don't know what that looks like. So these are estimates that will probably still be revised again.
Yeah.
And as they sort of said in this very detailed pack, they were kind of saying there are so many different people who have collapsed. We haven't actually included in FY27 all of them. So personal advice is a mess. So let's just ignore that for a second.
Oh, yeah, for sure.
But credit intermediation going down, which is good. And I think of all of the complaints that they were looking at, there was 10 that went to...
that were funded.
That went through the actual thing, through determination. So very, very few, a tiny little handful.
Yeah, it's... In the grand scheme of things, it's really slim in comparison to financial advice. So the scheme expects 10 credit intermediation claims during the levy period, and to finalise another 5. So 10 will be funded, and then they'll finalise the other 5.
And they'll go in FY28.
Yeah, but the costs to be paid are also significantly lower than the other sectors as well. I think credit intermediation is $100,000 per claim, whereas financial advice is far more significant than that.
They had also had an interesting point in the pack saying if we actually take into consideration all of the investors who might have made a claim that haven't, the cost in financial advice would be something like double.
Yeah.
So it's a bit like this could be way higher. It's a mess. I cannot, for the life of me, understand why and how this scheme is operating the way it is. Because, as we said, we've been looking at reforms and being like, how can this be more equitable? Because surely we can't be compensating people for missed gains, for unrealised gains in financial advice. But broking, we haven't got that problem, which is great to see. Talking about other things that we've been talking about, the other big theme this week has been mergers. A couple of more mergers have been finalised as the new financial year approaches. Summerland Bank and Regional Australia Bank completed on the 1st of July. So congratulations to those two regional lenders, customer-owned banks. Very nice to see a merger take place. And of course, one of many, many, many in the mutual banking space. So basically, they're quite small entities. They're both regional lenders. I think they now manage $5 billion in assets, so smaller side for customer-owned banking institution.
Yeah.
And they have 130,000 members collectively across 49 locations in both regional New South Wales and southern Queensland. So they were basically talking about the new merger and saying, for now, everything is pretty much business as usual, no main changes. We're going to continue on, but the merger really allows them, as nearly every merger decision has been talking about, allows them to kind of take advantage of economies of scale, investing in technology, investing in support for their customers, and investing more in their communities. So that was one. And as I said, lots of other mutual bank mergers taking place across the board.
Yeah, I think the most recent other one we've talked about was the merger between Australian Mutual Bank and Teachers Mutual Bank. And that was at the start of May. And they commenced operations as a sort of single entity towards the end of May, I think the 24th. But it's a similar sort of case. They're sort of working as a combined entity now, and they have that broader footprint. I think they'll have 13 locations all across Australia, across ACT, New South Wales, Victoria and WA.
Yeah.
And it's also a similar case in the sense that the Australian Mutual Bank retail brand will continue to operate alongside Teachers Mutual's existing brands, which are Teachers Mutual Bank, Firefighters Mutual Bank, Health Professionals Bank and Unibank. And yeah, I guess they're sort of bringing together those economy of scales that we've seen in a lot of the recent mergers, including the ones between Bank Australia and Australian Unity, Bank Australia and Kudos Bank, Auswide and MyState and Unity Bank and GNC Mutual Bank. So
And rumours of more to come down the pipeline as well,
Yes.
I've been hearing, which
Yeah,
is quite
exactly.
exciting. So we'll keep you posted when those have confirmed.
280,000 members, combined members between those two.
Teachers Mutual.
Mutuals Bank and Teachers Mutual is quite a lot.
Teachers Mutual. Well, they are one of the larger ones. They're not the largest, but one of the larger ones. And
Yeah.
Teachers Mutual has just been adding brands to its portfolio in the last few years. I mean, as you sort of mentioned a few of them there, Ben. But yeah, I think like a lot of the mergers, sort of TMB's been really consolidating a lot of the smaller players into one. So another one in this year. So as you said, 1st of May there, and I think they've been kind of filtering through the last few months.
Heaps of mutual mergers ever since I've been here.
Since I've been here,
Yeah.
pretty much since 2018.
I mean, it's only been 6 months, and
Yeah.
there's been a fair few. And I
3 or
know
4,
that
yeah.
APRA was speaking about it a couple of months ago as well.
Yep.
Of, you know, this conundrum that mutuals are facing, of can you survive on your own, or do you genuinely need to combine with another to ensure your survival?
Oh, I guess like if you think about the costs of cybersecurity now, like if that alone is a lot so if you only have, a few thousand members, less than 100,000 members, it's hard to stay, paying that kind of type of money out for cybersecurity and ensuring that everyone's protected.
Yeah.
For technology as well, people expect now to have an app, for example, to use AI, like all of these things cost money. And if you don't have that many deposits to actually utilize, then
yeah. It's a big existential question for that side of the industry, I
Yeah.
guess. And I guess all of the mutuals are just sort of looking at the other mutuals, standing around and saying which tie-ups make the most sense.
Yeah.
Or could I see myself working?
And we
with
have,
them?
as we talked about before in this podcast, not all of them have come to fruition. I think PNN and Beyond Bank had a couple that didn't actually come to fruition. So lots of different ones, like considering who to merge with, doing their D&D, and then kind of being like, oh, maybe it's not quite right. Maybe there's something here that we don't really agree with fundamentally, or maybe we just don't think it'll be in the best interest of our members. So lots to report on. We've covered a lot of ground there, gents, but thank you for providing your insights. Any nice weekend plans?
Not too much. I think I'll take it easy this weekend. But yeah, be raring to go next week.
Yeah, I'm watching a lot of football and tennis myself. How about you, Charlie?
Yeah, just taking a break. It's winter, so I don't know.
Hibernating.
Trying to stay indoors, although not overly.
Yeah.
But yeah, a lot of upsets in the football. So
Yeah.
hopefully, I don't know if you'd call Australia beating Egypt an upset. Maybe, but hopefully we get that.
So we're going to be coming back with you next Friday. But in the meantime, if you've got any stories or news for us, do reach out. You can reach me at editor@theadvisor.com.au. Of course, reach out to Charlie and Ben as well if you'd like to share any insights or stories with them.
For sure.
And do leave us your thoughts on what you think of the podcast. We'd love to hear your thoughts on the insights into what we provide you. Is there any other things you'd like us to cover? Leave us a review if you think it's great. We'd love to see it, but only if it's a nice one. We'll catch you next time for another episode on the Advisor Podcast Network.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.